Well, the housing sector is one we track closely, especially with all the focus on interest rates in the stock market. One housing play in the U.S. that a lot of people track is the home builder Lennar. Now, the shares have had a notable run over the last 12 months. After the latest quarterly results, we're seeing a pullback in the stock. We wanted to bring in longtime investor Ross Gerber, who is the president and CEO of Gerber Kawasaki, to talk a little bit more about what we learned with these latest results. Ross, it's great to see you. Obviously, it's been a very busy week where there's a lot of people wondering what kind of activity we'll see in the housing market as interest rates start to come down. With Lennar specifically, what stood out to you in these latest numbers?
I mean, I think most importantly for me is that their numbers have been incredibly good while maintaining margins despite the incredibly high cost of a mortgage for the typical consumer today. So this bodes extremely well for Lennar, medium, short, and long term, because the bottom line is Americans want to buy houses and they haven't been able to afford it because of the Fed. And now with the Fed beginning its interest rate cutting cycle, this will make Lennar's houses more affordable without Lennar having to sacrifice margins like they have been to subsidize mortgage rates and create incentives for buyers. So the fact that they've been able to, continually beat profits, have great numbers in this environment, there's still a massive shortage of housing in America. Like single-family home shortages is in the millions of homes we need to build. And I think it's something the government needs to address because many people want to buy a home and they simply can't find one today. So this is a combination of just wonderful factors for Lennar short and long term.
Any sense on what, at least for the specific stock weakness we've seen today, has been the catalyst for that?
Well, I think we've seen this across earnings. It's sell the news, companies report, they beat, they make every number, and then they sell off after earnings. But if you look at this chart that you have up, it's been a heck of a good 12 months for Lennar. I think it's up about 50% or more in the last 12 months. And over the last 5 years, it's up about 240%. So this is an incredible performer, an outperformer of the S&P, and still trading at a 12 multiple. These housing companies trade at very low multiples because they're typically not growth businesses. So you've got a positive PEG ratio, a nice dividend, and an extremely shareholder-friendly company that's buying back stock and paying higher dividends. I just don't, I look at companies, thousands of companies in the markets, and there's very few that are, I think, as well positioned as Lennar.
I love when the metrics come out in these conversations. Just for those who are not familiar with PEG ratio, why is that an important measurement for you as an investor?
So let me explain. PEG ratio is the difference between the PE that you pay, the price to earnings, and the growth rate of the company. At my firm, and my own personal philosophy for investing is I really look for firms that are growing faster than their PE. So if it has a PE of 15 and it's growing at 20% annually, that's a value in my book. So, we look for those kind of stocks. Now, if you look at the stock market today, you got companies like Apple, which trade at, let's say, a 30 PE and growing at more like 10 to 15%. So what we say a 2 PEG is pretty normal in the stock market today. So when you look at a company like Lennar with 20% earnings growth and a 12 price earnings ratio, this is an incredibly cheap company by the standards of its growth rate. So typically home builders are valued with low price earnings ratios because they're low growth businesses. But in this environment, it's just not being recognized for the growth business that it really is.
And for those who are curious, the consensus on Wall Street is that Lennar could see a little bit more of a gain over the next 12 months. We'll see how the analysts continue to react to these earnings numbers. Ross, I think I remember when I was last speaking to you, it was give or take a month ago, you talked about this broader housing theme played out through different names, whether it's in home building, whether it's in retail with like a Home Depot, I believe, whether it's you've got private equity titans like Blackstone, which some people in BNN Bloomberg land might know, has come knocking on Canada's door looking for real estate to invest in as well. So is your central thesis still that there could be some value in some of these housing-related names as this rate environment changes?
I would go a step further. The interest rate, really repressive interest rate situation the Fed caused over the last 2 years is really, really constrained real estate, private equity activity, market activity. Basically, it costs so much to borrow money. So much money is either sitting on the sidelines in CDs or at the bank, or people trying to do stuff are paying 10, 12, 13% interest rates. So with lower rates, so the fact the economy hasn't rolled over, and you have these real estate names like Blackstone and Home Depot that have managed to manage their businesses so well during the downside. Now, as we move into the lower interest rate cycle, and my basic perception moving forward is that the demographics of America, the AI technology landscape, and the fact that, you know, we have this, how would I say, really slowing environment because there's been no new construction really over the last year or two relative to the past. This massive slowdown, along with mortgages resetting over the next 5 years to much higher rates for typical consumers, you know, this is really a slowing trend if you look out over the next couple of years that we should be worried about potentially being recessionary. And so what we think is rates will go much lower, and it'll be a very, very supportive to housing, because that really drives the economy. And any way you look at it is new construction, and that's what we need to have start happening again in this country.